Hi, I'm Staci from Caliber, and today we're going back to basics with value versus growth investing. Investing is a bit like shopping, something I know a little bit about. For some, only the best quality goods or services will do, and you're willing to pay a premium. In our world, we call this quality or growth investing, when you invest in those really good, well-established companies that are growing more than their competitors. To get these characteristics, you're willing to pay up, even if the shares are a little bit expensive. Value investing, or contrarian investing as it's sometimes referred to, is all about finding a bargain, investing in unloved companies whose share prices have fallen. Just as some people hate paying full price and actively enjoy certain times of the year like Black Friday, bank holidays, or even January sales, value investors like finding companies that are trading cheaply. Their shares are currently worth less than they think they should be. But you have to take care. Sometimes when you go shopping in the sales, you get a great deal. Think 75% off a new TV, computer, or smartphone. But sometimes you really should have just left the mustard-colored jumper just sitting on the shelf because it looks good on nobody and there's a reason it's still there. The same is true for value investing. How do you know if you've bagged a bargain or a dud that's going to be out of business soon? To avoid these pitfalls, value managers need to build an understanding of why a potential investment looks cheap. It may be out of favor for good reason, perhaps because the management team have made mistakes or it operates in an industry that faces serious challenges. On the other hand, there are instances where investors may have overlooked positive change that is happening at a company or within a sector, and the share price could rise quite dramatically. Here is a selection of value managers who tell us how they invest.
So I try to compare what I think a stock is worth to the market price, and if the market price is significantly below what I think it's worth, then I'll buy. And that style for me has worked in the last few years. The ideal investment is a good business trading at a cheap price. But good businesses, if they're trading on an expensive price, are not interesting to me. So it's all about this comparison between what I think a fair price is and what the market price is. So whether it's a good business, yes, ideally it would be. But if it's a bad business trading on really cheap multiple, then I find those attractive too.
What we're seeing at the moment is we're seeing companies that are delivering year in, year out. They're delivering strong earnings and cash flows, and that's coming through, for me, importantly, in the form of rising dividends. So those dividends are coming through, and yet the share prices are not moving consistently with those dividends. Now, that means that the yields are at really high levels. I'm spoilt for choice on dividend yield, and it's not stocks that are yesterday's story, it's not value traps. These are stories that are still growing their dividends, often at a double-digit pace. So that's what we mean by value. It's not something airy-fairy. It's actually something that we can feel, touch now, which is rising dividends coming through and being delivered. And that's what we're seeing in the portfolio.
So we're looking for stuff that other people have thrown away. They've given up on it. They don't think it's worth their time. They think it's too complicated. They just think it's a load of rubbish. And we delve into that dustbin in the hope that they've thrown away something by accident. We don't buy everything on purpose. We're just looking for the ones that have been accidentally placed in that bin. And that really is the nature of contrarian investing. What's most out of favour that might have some great future.
So when most people are in a chair like this talking about what they do, they talk about the great businesses they invest in. They talk about the wonderful barriers to entry, the pricing power, the dynamics and the growth. And the problem with that is that there's only a certain number of companies in the world that have those characteristics, and everyone is looking for them. So it means the prices get squeezed up higher and higher and higher to the level at which you're unlikely to make a good return from. So instead, we look totally the other way. We look deliberately for companies with problems. But importantly, we look for companies where the problems can be solved. Because it's only by looking at companies with problems, and they may have bad headlines, bad sentiment, negative news flow, downgrades, profit warnings. So only by looking at these companies you can get genuine bargains. And as those problems that those companies have get solved, the profits begin to improve, and the valuation multiple improves as the stock market once again begins to fall in love with those companies. And the combination of the profits rising and the multiple increasing gives you some amazing long-term returns for our shareholders.
As you can see, much will therefore depend on investors' skill in distinguishing between a bargain and a value trap. Fortunately, as we've heard, a handful of talented value managers have shown the ability to do just this. To find out more about the funds mentioned, value investing, or value versus growth, please visit fundcaliber.com.